How did the Basel Accords impact capital ratios? Have you ever wondered how international banking standards shape the financial world? One key aspect is the Basel Accords, which have had a profound effect on capital ratios. Let's break it down. The Basel Accords began with Basel I in 1988. This was a response to concerns about banks' capital ratios during the Latin American debt crisis. Basel I set a minimum capital requirement of 8% of risk-weighted assets. This meant banks had to hold capital equal to at least 8% of their assets adjusted for risk. This was a significant step toward standardizing capital adequacy across different countries. Basel I introduced the idea of risk-weighted assets. Different types of assets were assigned risk weights based on their credit risk. For instance, government bonds had a lower risk weight than corporate loans. This encouraged banks to manage risk more prudently and maintain stronger capital. As Basel I evolved, it clarified what counted as capital. It distinguished between Tier 1 capital and Tier 2 capital. Tier 1 capital includes core capital like equity and disclosed reserves. Tier 2 capital includes supplementary capital like loan loss reserves. The Accord also recognized the need to account for risks beyond just credit risk. This led to amendments that incorporated market risk and allowed banks to use internal models for risk measurement. 2004, Basel II was introduced. It built on Basel I by improving the sensitivity of capital requirements to actual risks. Basel II introduced three main pillars: minimum capital requirements, supervisory review, and market discipline. This aimed to align regulatory capital more closely with the economic risks banks faced, including credit, market, and operational risks. It also allowed for more sophisticated risk measurement approaches. Then came Basel III, developed after the financial crisis of 2007 to 2008. This accord further strengthened capital requirements. It increased minimum capital ratios, introduced new capital buffers, and enhanced the quality of capital. Basel III also introduced a leverage ratio to limit excessive borrowing and liquidity requirements to ensure banks could meet short-term obligations. Overall, the Basel Accords transformed capital ratios from simple measures to complex, risk-sensitive metrics. They promote financial stability by encouraging banks to hold sufficient high-quality capital to absorb losses. This reduces the likelihood of bank failures and systemic crises. The evolution of these accords reflects a historical progression in financial regulation aimed at safeguarding the international banking system while adapting to changing economic conditions.